So good morning, everyone. This is Nilesh Joshi, Head of Equity Research at William O'Neill. I welcome you all to Walk the Stock, and we've got a very, very special guest today, today's edition. We've got Lakshmi Iyer. She's the Chief Investment Officer. She manages debt, and she's the Head of Products for Kotak Asset Management. She's been with Kotak since 1999. She joined as a fund manager, and then she was responsible for credit research as well as deal execution as well. So she's been a product specialist. She's had a lot of product initiatives with Kotak. And before that, she worked with Credence Analytics as a research analyst where she was tracking the bond markets. She's also from the same college that I graduated from, so Aripodar, and she's been a friend as well. So welcome, Lakshmi. Thank you so much for joining us on this edition of Walk the Stock.
Thanks, Nilesh. Good to see you, and happy to see a nice and vibrant audience on a Saturday morning.
Oh, absolutely. I think the scare, Lakshmi, is that 10:30 in the morning on a Saturday, a lot of agendas planned, and still coming to hear you out. I think that's one thing that sounds very, very good. So let's jump directly, Lakshmi. I think without any further ado, because I think a lot of investors have joined in, few more joining in, but everybody has these apprehensions at this point of time, right? What the Fed statements had come out with, the yield curve, right? Because that has become a hot topic and a hot talking point suddenly over the last few weeks. So how do you see these macros in the first place in the US markets building up or the global developed markets? And how do they basically affect emerging economies like India?
Sure. I think to start with this question, I want to take all of you back maybe 15, 16 months back at the start of the pandemic. Everything was going good. The directions of the wind also were in the right direction. Your compass showed everything perfectly right. Till one day, this invisible monster, COVID, struck. And obviously, all the economies were left grappling. And since then, what happened is that the potential malnourishment fear led to central bankers across the world pump in steroids into the system to ensure that there is no scenario that you actually end up getting weak. And then when I talk, you need to visualize your own body system to just kind of extrapolate into the economy. Now, at the current juncture where we stand today, the malnourishment is almost abated. The central bankers are now fearing a potential, possible obesity across the globe, whether it is the US, whether it is the other parts of developed. Maybe Japan is some exception, wherein there is still some amount of deflation, but that's a 30-40-year problem, not a 20-30-week problem. And I think that is the mood right now, and therefore I call it the winds of change from a macro perspective. Just to share with you, very recently, yesterday, Mexico actually hiked interest rates by 25 basis points, and it was a surprise one. Prior to that, some of the central bankers which have hiked rates are Czech, Hungary, I think Russia hiked rates, Brazil, Turkey. All of these have hiked rates, fearing that there will be a bloat in the economy leading to obesity. In some cases, hyperinflation, where countries like Turkey is concerned. In some cases, probably stagflation. So I think that is the mood which is being characterized from a global macro perspective. And I don't think India is significantly different. Of course, there are shades of gray. Sure. You can't compare, but yeah, we are also pretty much moving in similar direction.
Sure, Lakshmi. So I think the mood point here that I take away from your opening remarks is that if the obesity and the inflationary trends, with a few exceptions like Turkey, which show hyperinflation, or Japan, which obviously show signs of deflation not coming off at all, this inflationary trends is something which is scaring the markets, right? Even Powell's statements of taking inflation from 2.4 to 3.4, and with such surplus excesses in terms of savings in bank accounts in the developed world, once this comes through aggressively, either cost push or demand pull, what do you think is the threat? I think if inflation rises faster, will the tapering off, I mean, it's anybody's guess. I mean, he said 23 is 2 rate hikes that he's talking about. But do you foresee any potential risks in terms of any of these inflationary fears going beyond Fed's control and a reduction in the timeline per se, and the reaction in terms of bond yields and dollar flows?
So, Mayuresh, right now, the biggest threat for me, as I observe from a macro perspective, whether it's globally or for that matter closer home in India, is not so much of a cost push or a demand pull, or, because discretionary spends are down. I don't have to look elsewhere. I look at my own house. I'm a diehard foodie. But I don't know when was the last I visited a restaurant. When the first wave abated and things opened up, there also there was reluctance in going, and of course for the last 3 months things are back to square one where things are closed. Discretionary spends are down. I used to take one big holiday a year, and that I think most of us used to do for a block of about 10 to 12 days, and maybe small weekend trips over a Saturday, Sunday. Now again, that has almost come to a standstill. Sporadic travel is still happening. Now that is not my concern. If you look at the supply side constraints, and again this can be extrapolated globally, the lockdown in the first phase was very severe. Now the intensity is much lower because it was localized and things were operating. The biggest fear I have, therefore, on an inflation, if this sustains, is that of negative real rates. Whether we are talking about India as a land of savers, or we are talking about US, where the savings rate have been going up, it is the negative real rates that concerns. So look at US inflation, 5%. Look at US 10-year, 1.5%. So you are, expending on your personal income at the rate of 5%, whereas you're earning 1.5%. Look at India. Your inflation CPI, which impacts you and me, is 6.3. Let's not get carried away by 6.3. Even if you take the average, maybe it's 5.5. And if you look at the 1-year treasury bill rates, if you look at the 10-year bond yields, you're just about flat. But if you look at the other bond yields, including traditional mode of investing like bank FDs, etc., again, you are back-to-back second year on negative real rates. So therefore, the concern is, will there be a rush, I won't say a beeline exodus, but will there be a movement to hard asset classes or physical asset classes like real estate and gold? I think that is something which world central bankers have to take serious note on. And mind you, despite the fact that this FOMC meeting which went by was perceived a little bit hawkish, gold has barely corrected. Yes, it has come off from the peak levels, but we don't really call it correction. We've been enough, all of us in this market to know what correction is. It's just like a small prick on your elbow, which you don't even realize. So I think that is the bigger worry which central bankers will have to grapple with as they move along and maneuver these winds of change.
Absolutely, Lakshmi. I think there have been very teeny minor corrections that have probably happened. If I can put it across asset classes, but that's where the fear is, right? What will lead to a trigger? Because I think the asset classes have moved up significantly. So the risk factor that people are perceiving, people who are out of these markets or not invested in any of these asset classes, what is the fear or the risk factors that can actually pull them down significantly? If you can elaborate it.
See, as I said, one is there is extreme and FOMO, and that FOMO I observe is not just for equities. Apart from fixed income, I think there is FOMO everywhere. Fixed income people are saying, "यार 3-4% मिल रहा है, इसमें क्या कौन सी बड़ी बात है? इतना तो हम एक दिन में कमा लेते हैं." That's kind of become the mentality. I was talking to one gentleman yesterday. I said, "हाँ, around 4 to 5% expectation रखना चाहिए fixed income में." अच्छा, दिन का आप भी दे दोगे 4-5%? That was the mindset, and I had to tell him that, look, fixed income managers talk annualized, and what you get in equities on a given day is absolute. So the FOMO factor is leading people rush to land, real estate, equities, and you would be observing this, much more closely than I do. That the cash volumes have suddenly shot up. People are, I was told yesterday by someone, who is part of the institutional broking segment, that people, their own clients, are actually profit booking, probably in mutual funds and opening accounts to trade directly, saying that, "यार, fund manager तो इतना इतना ही देगा, हम इससे प्लस प्लस कर लेंगे. So these are, you know, some of the concerns I have, where if the discipline is lost. See, the key word here is discipline. If there is discipline, you can make money out of hay also. You just need to quote hay and there is money to be made. But if you do not, I you know, borrowed this terminology from one of my equity fund manager colleagues, called CBM. For those who don't know what CBM is chor bane more. Now, chor bane more stocks are dancing even in sunshine. And I was told in school that peacocks dance usually only in rains. Now, so these are some of the pitfalls I think we as investors or money managers or aspiring traders, we all need to be mindful of all of these, because all good things also come to an end. They move in cycles. So one needs to be extremely conscious of that. Equity markets, for example, right now is in Trishanku zone. For those who understand mythology, Trishanku had a boon that nobody can kill him on land, nobody can kill him on air. So therefore, he was actually latkowed, like right in the middle, and he was butchered. So one needs to keep in mind that equities right now is neither expensive nor very cheap. It's somewhere in that twilight zone, and therefore one needs to be very mindful. And therefore the key word here is discipline, and the next key word is asset allocation. So if you have these two as your armors, the chances of going completely wrong is very limited.
Absolutely, Lakshmi. And for all the folks who are tuned in today, I think that's very sane advice, right? There will obviously be a feeling of missing out, as Lakshmi pointed out, and there is in the markets at this point of time across asset classes. And therefore, I think being a little bit diligent, being disciplined becomes necessary. Irrational exuberance, I think that's the term that gets used every time when markets hit peaks and when there is a lot of excesses being played out. So, Lakshmi, if a retail investor, right, because there is a lot of retail audience who's listening to you right now. So if a retail investor has to come to you at this point of time and ask you, right, Lakshmi, if I've got an XYZ amount of money, maybe I'm 50-50 in terms of risk reward when it comes to equities and other asset classes. How should I position myself from now over the next few years? So what would be your take in terms of asset allocation?
Couple of things here, Mayuresh. There is no one size fits all.
Absolutely.
So, you know, somebody who looks alike to me, and I'm told that man or woman have 7 faces, and they could have similar constitution as well.
Sure.
Our risk appetite and our ability to fathom volatility could be significantly different, and therefore one could be a coconut and one could be a mango. Mango is slushy from out and slushy from in as well, whereas coconut is hard from out and tender from inside. So if you are a mango variety investor, then you are better off taking a low to moderate risk as far as your portfolio is concerned, which means this kind of a portfolio can actually be oriented towards a combination of fixed income and hybrid strategies. Now, what are hybrid strategies? Hybrid is a cocktail. Saturday, so I have to talk about cocktails as well. So it's a combination of fixed income equity. In some cases, it's a combination of gold. It's there in a proportion, pretty static, but that's a good way out to ride volatility. So these are for the mango type investors. What about the coconut type investors? Coconut is hard from outside, so they see volatility. They don't get unnerved, but man mein that tenderness is there. Ab kya hoga, ab kya hoga. But since they are hard from the exterior, they can still end up taking moderate risk, which means your portfolio can be oriented pretty equitably between a fixed income and a...
Sure. Lakshmi, can't hear you. Yeah.
No, the host muted me. No marks for guessing. Somebody who is a coconut outside and the coconut shell inside, which is hard and hard, then your portfolio can be oriented a larger extent on the equities front. The key to note in all these underlying is that it is the time that you have to give to an asset class to perform. I think that's exceedingly important. And I keep sharing this with all our viewers, and I think I can share that with you also, that for me, for me, the god of cricket was always Sachin. Of course, there are many others who are way better, or who are the cult right now. But I always tell this, that Sachin in his entire career faced over 32,000 balls in his cricket career. Now, did he hit every ball? The answer is no. His strike rate was just about 50%, which is around 16 odd thousand balls. But when to strike that, for that you have to be at the crease. And that's what I keep telling all our viewers and investors, that be at the crease, lage raho. I think lage raho is the critical thing, because if you are going to be, even if you are a coconut investor, hard outside, hard inside investor, and if you are going to say, yaar, ek mahine ka paisa equity mein laga de, then even coconut can be broken with a hammer. So one needs to be very, very mindful of that.
Oh, absolutely. In fact, I saw a meme which showed a tree which had bananas, which had coconuts, which had papayas, which had mangoes. So I think the expectation, Lakshmi, you can see, is largely that people want all the fruits from one tree. So again, coming back, right? A lot of people are still not aware of how fixed income works, Lakshmi, and you being heading this division for a long, long time. If a retail guy has to diversify his risk, right? If you want to put it in a nutshell, how should he approach the fixed income market? What should he understand as 3 or 4 key pointers that fixed income, what fixed income markets are, what do they offer, and how do they help you in diversifying your risk?
So I quote this to almost everyone who is a novice in fixed income market. The only thing fixed about fixed income is its unfixed nature, which means that in fixed income, we cannot assure returns. If you go to a bank fixed deposit and you give $100 today, at the end of year that if 5% is your contracted rate of interest, at the end of 1 year, you get that 105 rupees, unless obviously the bank goes down under. But in fixed income, what happens is that there are market movements. So there are two components in which, or a way in which a company chooses to grow. They choose to borrow or they choose to raise equity, which is obviously the share capital that all of us own via stocks. And then there is debt or fixed income that they raise, and they contract with you that they will pay you some coupon rate, or a rate of interest or whatever they will give you. But that's the contractual agreement between the issuer of a debt. Let's assume it's Government of India. Government of India says that at the end of 1 year from today, if you give me 100 rupees in treasury bills, I will give you back 104, which is 4% on that. I'm just rounding off numbers to make it easier. Now, is that 4 rupees cast in stone? Yes and no. Yes, if you hold that entire 100 rupees for 1 year tenure, then even Brahma cannot come and take away that 4 rupees. Brahma is in Lord Brahma, okay, not any other Brahma, because Government of India is sovereign risk. So therefore, credit risk is not there. There is an interest rate risk.
Yeah.
Now let's assume that I'm holding this 100 rupees and Government of India, I have bought this at, say, assuming I get 4% at the end of 1 year. Now, what happens for some reason, the world were to go awry, COVID is out of our lives and interest rates sharply rise. Then 3 months down the line, the same Government of India will come and say that, okay, this 100 rupees against this, if, I will give you instead of 4%, say I will give you 5%. So you're getting that 1% extra. But what happened to that investor who 3 months back bought it at 100 rupees, automatically his or her 100 rupees value comes down because you're getting now higher yield. So therefore a lower price. So this is the classic bond price and yield relationship, that as interest rates go higher, the price comes lower. But the beauty is that the portfolio, and we are talking about portfolio, right? I will not have just one stock in my portfolio. Okay, I will have a basket of portfolio. So the beauty is, as interest rates are going up, my portfolio yield is also going up. And therefore, there are two terminologies in fixed income: carry and capital gain. So that's as the yield or the YTM on my portfolio goes up, automatically the carry starts improving. So this is, in a very simplistic terms, and suited to the interest rate environment, there are multiple strategies, which obviously cannot be discussed in such a short tenor, but this is just to give you a flavor as to how the fixed income market operates.
Oh, absolutely. And thanks for that, Lakshmi. I think I hope the viewers took note of a very simple explanation on how fixed income works. Now, in your statements, you put in a very important and a very important criteria in terms of credit risk. So I think how do the credit agencies map this credit risk, right? Obviously, there is a lot of due diligence that is done. But when corporate bonds are issued, right, and when they are issued with a certain credit rating, how are investors supposed to look at that? If corporate bonds with the highest credit rating is issued, does that assure investors that they will get a 660? I'm just giving a hypothetical example.
Yeah.
That is better than a government bond by 100, 200 bips. But the risk factor is also there. So how do we perceive this? Do we only go by the credit rating? Because a lot of investors will not have the acumen to probably look into the details.
In fixed income, there are two key risks. We spoke about the interest rate risk. As I said, you buy an asset yielding 4%, then interest rates go up, then obviously your price point comes down. The second important and very integral risk is the credit risk. And the word risk itself is the most forgotten four-letter word in good times. And I keep telling this again that, risk is something which is non-negotiable. Don't keep it on the back of your mind, keep it right in the front. It has to be a platter served every day. So credit risk, therefore, is imbibed in every fixed income strategy. The degree varies. As I told you, sovereign, government of India, the perception, okay, no credit risk because it's government of India who's issuing. Likewise, if you go down the radar, there are various ratings which have been accorded by rating agencies. Now, these ratings are accorded basis what? Basis the health of that particular issuer. How are you? When you go to your physician for a checkup, they check out all your, the BMI as they call it. And after checking out various other, they do a few tests and they tell you, oh, you're in good shape. Oh, no, your lipid profile is bad. You need to do something about it. And accordingly, you are also graded. So similarly, rating agencies do it. And what is the health check of a corporate? Health check is the crux, or I would say the heart is a cash flow. You track that for equities also, the free cash flows. Is the company in a position to consistently throw free cash flows so that they have the ability to service their debt? I think the same thing is done by banks when we apply for home loans. They actually look at our income profile. So identical stuff is done by rating agencies. Then they also obviously look at how much is the potential to borrow. If you have 100 rupee equity, you can borrow 200, you can borrow 2000, depending on who the entity is. If you go excessively overboard, then the typical assumption is that you enjoy a lower rating. And last but not the least, you also look at the governance, which is the qualitative aspect, the pedigree of the management. Is that particular entity a leader in that business, laggard in the business, upcoming? A whole host of these factors go into determining a rating. Ratings, according to me, is a hygiene. It's like Google Maps. Wednesday I had to go for a meeting. Google Map from BKC to Kulaba, it showed me 50 minutes. It took me 1 hour and 30 minutes. So a good 35 minutes more. So Google Maps does not necessarily guarantee that I will reach my destination on time. It's a cool post. It just gives me an andaza. And likewise, a rating also is a necessary condition. It is not a sufficient condition. But there are a whole host of other things which are required. But broadly, you can assume that the metrics of a AAA to all the way down to BBB minus takes into consideration most of these factors. So the healthier these numbers, you typically tend to enjoy a higher rating and vice versa.
Oh, absolutely. Point well taken, Lakshmi. Thanks for that. I think it was a very lucid explanation to put it. But on the risk, as I see it, if you would have seen the net series Scam, very famous dialogue, risk hai to ishq hai. So there are a lot of risk takers in the market as well. So if any retail investor, Lakshmi, has to come to you and say, suggest me a few schemes on the fixed income side, or suggest me a few bond issuances which are looking good over the next year, 2 years, 3 years time frame, can you have any recommendations for them?
Fixed income, as I told you earlier, has strategies suited to all occasions. And this is, the period of monsoons, for example, in India. And even in fixed income, there is something known as all seasons footwear. So, whether the interest rates are rising, whether interest rates are flat, or interest rates are going down, those which are those funds or those strategies which have low to moderate duration, where if you see the portfolio, most of the stocks or most of the securities are, say, maturing in the band of, say, 1 to 3 years or 1 to 4 years. That's called low to moderate duration. That is something which we find appropriate in this market scenario. Now, why would we say this? It's like, if you would say that, again, sorry, bear with me, I'm a foodie, apart from being a filmie. Somebody were to serve me sarson ka saag in monsoon or in summer, I would say no, this is like a winter item, typically. Okay, undhiyu for a Gujarati is again a winter dish, but avial for a South Indian is all round. It's got the right mix of all the ingredients, and the platter can be served all through the day. You can have it with appam in the morning, or you can have it with your rice in the afternoon, or you can just have it like a stew at night. So I think those strategies, like floating rate funds or the short-term bond funds, I think they come in this avial category, where, for example, in short-term category, the duration restriction as per regulation is in the band of 1 to 3 years. So that makes it, kind of an all-weather sort of a strategy, compared to an undhiyu. As I said, you might not even get all the ingredients, at this point in time, and even if they were available, you may not want to buy it. So those are, largely the very long tenor duration funds, which don't have any cap on duration, and therefore the Gita ka sar, I would say, is the strategies that you need to look out for are ones that probably are zor ka jhatka dere se strategy, which means low and moderate on duration, and certainly low on the credit risk front. So I think these are the two factors that you need to watch out for when you are contemplating your investment starting now.
Oh, absolutely, Lakshmi. And when you're talking about food, I think if you go to a buffet, right, it's not necessary that you have to stack all the items on your plate, right? You have to take what suits your palate as well. So point absolutely taken. Now let's move to a different asset class altogether. Gold becomes the talk of the town in mid cycles, in cycles, in the interim period when the risk starts coming significantly in equity risky assets, as we put it, or risk on assets. So how has been the gold trajectory so far? What is your perception right now? And where do you forecast gold to be over the next few years?
Gold has had a spectacular innings, in the last, maybe last 1 year, gold returns are negative for two reasons. One is there was a price point correction in gold, and second is obviously we saw an appreciation on the rupee versus the dollar. But apart from that, if you see over longer periods of time, gold has not really defied or belied investor expectations. But let's take, if you look at 2 year, 3 year returns, they look like 14, 15, 17% thereabouts. But if you look at a 10-year period, the returns would look at something like 6% or 7%. So two thoughts on this. One is on the way forward, I think the trajectory for gold, I think the view, I started off saying that, the monies can potentially globally move into hard asset classes or physical asset classes like gold. And that momentum will continue to support gold prices in the medium to long term. Near-term corrections, etc., because of dollar strengthening, that's something which we need to take it in our stride. But when you talk about exposure to gold, so that's the fundamental view. I always urge investors to treat gold as a term insurance. And I'm using mindfully the word term insurance, the way you would take a term cover on your life, treat gold as that proportion in your overall financial portfolio, which means make sure you're covering your life. So to cover your life, you've got a very inexpensive product called term insurance, which, if everything goes well with your life or with yourself in the next 30 years, that term insurance premium that you paid expires worthless. But it is a last man standing or the last woman standing in your portfolio if something happens to your life. So I think that's the role that gold has to play in your portfolio. So have it definitely. I don't envisage that anyone should not have a term cover. Likewise, I do not envisage not owning gold in your portfolio. But will you make term insurance an investment product? Answer is no. It is a risk cover. So treat gold as a risk cover. It is very incidental that you're making money in gold. But please don't try to dabble in gold unless you're I call it artist or a chartist. Unless you're a chartist and you want to make those quick bucks. But for every other people, okay, as a fundamental investor, please have that much of gold that will take care if the world were to come to an end and a tsunami were to drown your portfolio. But the outlook on gold, as far as we are concerned, we are constructive on gold prices.
Yeah, so folks, again, Lakshmi is very, very optimistic on gold, and the message here is very, very clear and simple. I think small proportion, not to take it as an investment bet, a small proportion to probably hedge your portfolio in worse times if they come through. Lakshmi, a view if you have any on cryptos, because that's one hot commodity right now at this point of time, right? Elon Musk tweets, Bitcoin reacts. I think that is what I would simply put it in one line. But a lot of cryptos have come through. Does it make sense in terms of some exposure? I know there are a lot of regulatory issues locally and globally as well. But if regulations do allow at any point of time, would it then make sense to use cryptos? A case in point being Bolivia, if I'm not mistaken, has ensured that from September it becomes legal tender in their country. So do you think acceptance of cryptos will be a given, if not now, over the next few years? And should an exposure towards these cryptos also be given?
So, Mayuresh, my question to you is, will you watch a Korean movie without subtitles in English? If you understand Korean, fantastic. If you don't understand, which is what I would say most of us would be, for those who understand, please do it. And I think that's my answer. Just because you are weaning off meat, it's not stylish to eat mock meat. You need to understand that even mock meat could have certain ingredients because they are plant based that may not suit your palate or they may not suit your digestive system. So I think that is my one point answer to cryptos. It's a massive world. We don't know how the demand is. We don't know how the supply is. It looks like Rajnikant at times, but other times it looks like Fata poster like in Nikla Zero, not Nikla Hero. So there's a mixed view that is emanating out of crypto, and acute FOMO, I call it. Acute FOMO factor is gripping investors. यार इसमें तो 100% कमा लिया लेकिन उसमें 1000% छूट गया. So how do I do it? So let me get into it. I think that is Vinashakale Viparita Buddhi, I call it. It's not recommended to those investors who don't understand it. I honestly claim no understanding on cryptos, but for whatever I read, thanks to my avid reading habit, I continue to believe that if you have an ambition to create wealth, which I think is a very serious ambition and an important ambition to have, and if you have the right allocation of financial asset classes and sparingly gold and of course to some extent real estate, I think you've achieved nirvana.
Absolutely. In fact, Korean movies showed the Lakshmi. मुझे English movies में कभी-कभी subtitles लगते हैं. So forget all that. So the other asset class that you spoke about right now, right, real estate. And when you're talking about going to the hard asset classes, right, do you think there is a paradigm shift that you're probably seeing right now? How do you see real estate as an asset class right now? With work from home, I think a lot of things are evolving and changing, right? A lot of corporates are saying work from anywhere. So do you see this asset class actually evolving, not from a tier one perspective? So forget cities like Mumbai, Chennai, Delhi. Do you see real estate actually picking up and hotting up in tier 2, tier 3 cities?
That trend is already underway. One is the work from home has made people realize how much they can tolerate less of each other. So therefore, they need to have a slightly more density to ensure that they are seeing less of each other in a given space area. Jokes apart, but there is a conscious spending happening on beautifying or improving your home space, which means that your existing home itself is getting done pretty much well. So that's why the home building sector is doing well. Or there is an aspiration to move or to own a bigger apartment. So you can lease out your current one, you can buy out one, or whatever combination. So that trend is underway. It is happening. Therefore, we believe that that sector, which was under the eye of storm for the longest time in terms of inventory pile up. I'm sure every Sunday newspaper you pick up, there would be that right hand side column on how the number of unsold inventory is in various cities, especially the top 8 cities in India. I think some bit of that is giving way. At a price point, things look pretty attractive. Mumbai, I'm told, is more expensive than Manhattan. Will everyone rush to Manhattan to buy an apartment? Answer is probably not, unless you have your child studying out there or you plan to migrate there. But yes, the tier 2, tier 3 locations are actually witnessing a jump. It seems to be a sustainable jump, but as I said, everything looks good at a price. And I often share this with the real estate lovers. If you're smart, you will buy one house. If you're rich, you will buy two houses. And what if you do three? You're a fool. Because real estate is ultimately a physical, illiquid, immobile asset
Yeah,
class.
exactly.
So, putting mindless money into real estate, hoping that it will appreciate, I think is a fool's paradise.
Oh, absolutely. Wonderful explanation given. In fact, you got a very good comment from Sudhir Arora Lakshmi. You are a genius, mesmerizing explanation. Really. I just wanted to put that through to you. In terms of exposure to gold, Lakshmi, I think what's the best way to do this? Gold bees uh, or physical gold? Because physical gold will not make sense, right? You're probably looking at physical space to unless you're buying it in huge quantities, right? You need one more apartment to probably store that. But what's the best way to buy paper gold? I think, is it gold bees or anything else that you're probably looking in terms of any schemes? So has Kotak come out with a scheme which probably has an exposure towards gold in their in one of their schemes?
So, in Feng Shui, people believe that if you bury gold bricks under your foundation of your house, it is considered good luck. But I told myself that if I have to buy that kind of gold, then I'm not contributing to the good of the economy, because somebody has to import that gold for me to buy. So physical gold, to my mind, again, has got its own storage issues. You have to have tijori in your house. You have to store in your closet, in your wherever you want to store it. I mean, I don't want to let imagination run wild. Or you need to keep it in your bank locker, but the size of the lockers that are available. So therefore, there is a very smart way of owning this gold, and the smart way to own these gold is through a paper gold, which is sovereign gold bonds. Now, हमेशा इंडिया में एक कॉन्सेप्ट होता है कितना देती है, हमेशा गाड़ी खरीदने के पहले माइलेज का इशू होता है. तो यहाँ पे द सॉवरेन गोल्ड बॉन्ड एडवांटेज इज दैट ये एक्स्ट्रा देती है. So apart from giving you returns of gold, which is the underlying asset class, it also gives you a 2.5% extra, which is an assured return of 2.5%. Which means अगर दुनिया में कुछ भी हो जाए and gold doesn't do anything, for example, at least you get 2.5%. So mentally you are in a much better situation. You're not owning that gold in your locker. It's your demat holding, or gold ETFs are another mode of ownership, because these gold ETFs are backed by physical gold. So therefore, I want to share with you a high point of my life where I convinced my mom not to actually buy physical gold. Every time when there is Dhanteras or Akshay Tritiya or Diwali or Dasera, she'll call me and she'll say, what, let's buy gold. I say, let's buy. No, you can buy. I will not buy. That was a narrative till maybe 15 years back. And ever since then, I've been trying to chisel into her head. Finally, maybe 5-6 years back, she got convinced that, no, what you're saying is right. There's no point having, because even though she has a small locker and that gold, every time she goes out, she is worried, what will happen to my gold. That fear is always there. And these are that generation people who don't even want to keep gold in their lockers. So I think the electronic mode of owning gold via SGB, sovereign gold bonds or ETFs, bear in mind, both are good, but SGBs or sovereign gold bonds will mean lock-in. There is a lock-in for about 5 years, and after which you can exit. But if it's a small proportion of your wealth, you don't mind, letting that illiquidity run for you. So combination of gold ETFs and sovereign gold bonds would be my pick.
Oh, absolutely. So, will a 5-gram gold coin, if I hide it under my floor, bring me luck, Feng Shui? Because that's the only physical gold I've got. Anyway, so yeah. So I think one more question which has come off, right? Apart from all the asset classes that we discussed, commodities, right, as an asset class as well. So you've seen this huge steel cycle built up. Copper had a fabulous run last year as well. So how do you see these commodities, ferrous or non-ferrous, play out? Do you really think, I think the entire mechanisms that China or even Russia is putting through at this point of time, trying to curtail inventory at this point of time and therefore keep a check on prices will really work, or are we really in a super cycle when it comes to these commodities?
See, the jury is yet to be out whether we are in a commodity super cycle, and of course, the proxy for playing those commodities for those who don't buy them directly obviously have been equities, and they've had a dream run. I would say dream run, with that, like they say, Sunny is a car. So it's that kind of a dream run they've had. The only key question is that the jury is yet to be out whether this is a sustainable cycle, because we are in an economy globally where inflation is rising, but the economy is not keeping pace, and therefore the estimates of growth are being downgraded most across parts of the world. So in an era where growth is not coming back with a vengeance, see, most industrial commodities require a buoyant economy to continue their dream run. So therefore, are we in a multi commodity cycle bull run? I would want to reserve my thoughts on that for now, because I don't have enough data points to confirm that in the affirmative. But yes, we have seen a run. There is no doubt about it. Some bit of it momentum, some bit of it sentimental and fundamentals. It's now kind of plateauing out, and no marks for guessing. Either the next move can be this way or this way. I think that's the best answer I can give right now. There would be a distinction between commodities, those which are being used in segments where the demand has been pretty strong. I think they can sustain their momentum, which is why you're seeing in quite a few of the commodity companies, you're actually seeing deleveraging, because there is no capex happening. So what do you do with kind of strong cash flows? You're actually retiring your debt. So that's the kind of cycle that we are seeing, which is why, as I said, commodity stocks have been doing phenomenally.
Sure. Thanks for your take on that. Now, when it comes to India, Lakshmi, from a macro perspective, obviously we've heard the governor a couple of weeks back. Your own take in terms of the inflationary trends when it comes to India, the bond yield curve from an Indian perspective over the next few years, and therefore the entire take in terms of the macro dynamics on key data points that we are looking at, right? Whether it's PMI, IIP, we've seen an exuberance in terms of foreign exchange reserves at this point of time. So I think if you have to put it in context, how do you see inflation shaping up? How do you see RBI policies shaping up, view inflation over the next few quarters? And therefore the macros in terms of the GDP setup, how do you think that will go specifically in this second wave hit that we've got? And how much time will it take for recovery in really becoming that 5 trillion economy that we're looking?
My take is that the two V's, which is virus and vaccination, will actually shape the monetary policy decision making going forward. The macro picture is giving you mixed responses. If you look at business resumption index, it has started taking off, but it's in certain sectors. There are certain production oriented sectors and consumption oriented sectors where again the high frequency indicators are giving you mixed signals. There is no wishing away the fact that not only the headline number, which is a CPI, which is at 6.3%, but also the core inflation. So, the central bankers in India also look at the core inflation, which you remove food. Food keeps moving up and down. Onion prices are sometimes $100, sometimes $10, sometimes $20, $30. And they also remove the fuel items, which is also typically very volatile. The fact of the matter is that even after excluding these two components, the core inflation remains very high or sticky. This last month, it came in at 6.6%. That is not something which is can be ignored completely. Well, you can afford ignorance for maybe a couple of months more, but our sense is that the central banker will have to take stock and probably embark on a normalization of policy. Now, what does normalization mean? Normalization does not mean inflation high hai, chalo repo rate badha do. No correlation here, no correlation. I have a cough and you start giving me Combiflam. It's not going to work because Combiflam is for pain relief. I have cough, so you please give me Benadryl. It gives me a nice sleep. It makes me feel as if I'm having alcohol if I'm a teetotaler, and I feel good about it. Okay, so I think that is the process of normalization that you need to embark. And in monetary parlance, normalization means what? Liquidity. If the liquidity in the scenario in this banking system right now is close to 8 lakh crores, announce a game plan to gradually reduce this liquidity. That is number one. Number two is when you started off easing campaign, in COVID phase, March 2020, May we had a rate cut. That time, the gap between the reverse repo and the repo rate was just 0.25%. Those normal times. These were extraordinary times. So आपने जोर का झटका जोर से दिया and you actually cut reverse repo faster. Now is the time to normalize that gap and gradually bring the reverse repo higher, keeping repo where it is. So I think these are some of the techniques that you will have to embark on a normalization rather than saying that, oh, inflation is high, so let me start hiking rates. I don't think that is going to work, because if you do that, you run the risk of further axing the already the I would say, not fragile is not the right word, but a slightly tepid growth. And there is a growth narrative which we all need to have, because if the GDP expands, that is when sectors start contributing, that is when employment, and it's generally all good. In Sanskrit is saying loka samasta sukhino bhavantu. So when everyone, if the GDP is doing well, underlying sector automatically starts doing well. So I think that will be the mindset of the policymakers going forward. I don't think they will be in a very tearing hurry. They may uptick the inflation forecast by maybe 0.5% or so, because they have to be very realistic when they are giving those numbers. So I think that will be the way forward. But bond markets, being bond markets, they've already started pricing in that, there is going to be doomsday ahead. And the yields have already inched up by almost 20 to 25 basis points, barring the 10-year. The 10-year is, right now not the right way to look at it. It's like, you see Nifty. But in Nifty, there are 5 stocks which are rockets, 5 stocks which are downward to ski rockets, and then there are those 30, 40 stocks which are always, doing a round robin. So likewise in bond markets also, the 10-year benchmark is just held on with a string quite tight, because the RBI bond purchases is happening predominantly in that segment. So expect that there will be normalization of liquidity. Bond deals, according to me, the yield curve is very steep. Today, if you buy a 3-month asset, just to give you an example, it will say it'll be available at say 3.5. But if you want to buy a same asset of a very good quality credit, but you want to buy a 1-year asset of the same issuer, you will get close to 4.25. So a 75 basis points additional for just 9 months extra. That is one of the steepest yield curve that we are seeing, which is why this normalization is kind of priced in, not 100%, but at least 70 to 80%.
Super to hear that. So the logical step, Lakshmi, then would be that RBI should not be hiking rates, right? I think they should be having a more practical, a pragmatic, and a cognizant view in terms of saying that this inflation is transitory in nature, transient in nature, and it will ultimately normalize. But since liquidity is high in the system, I think hiking the reverse repo will make better sense rather than hiking the repo and then putting additional burden in terms of sectors. Is that the right way to interpret and put this?
Yes, the reverse repo, and as I said, the VRR, or the variable rate reverse repo. So RBI, assume all of us in this room are bankers. RBI is taking money from us on a daily basis, and that rate is at the reverse repo rate, because RBI also has to make money, right? So if you want money, they'll give you at repo. If you want to lend money, you lend at reverse repo. Now RBI introduced VRR, variable rate reverse repo, on 8th of January. And they said that if you have long-term money, so I can take 2 lakh crores, 14-day repo, a reverse repo, you bid for it. So that money is, you can earn some chavani extra, not chavani literally, like 10 to 15 basis points. Now, maybe RBI can extend this to, say, instead of 14 days, they'll say, okay, I'll borrow money from you for 28 days, or maybe for 45 days. So I'm willing to give you that little bit extra. So that is another way that they can normalize by taking out liquidity from the system for a longer period of time. So these could be the 2 measures, unless the Edward de Bono hat leads them to think out of box, which I am not able to think on a Saturday morning right now.
Neither me, Lakshmi. I think there were 7 different hats, so let's forget that at this point of time. So a couple of questions before we end, because we are almost closing on to an hour. Investor has a question. Lucy Master has a question. Obviously, you've got colleagues in the equity space as well. and some viewpoints that you share with your colleagues or they must be sharing with you. Is it fashionable to say that we're in a structural bull phase that will last for 4 to 5 years? What's the opinion of Kotak as a house?
It is always not fashionable to state the facts. Crow is black is a universal truth. And my wall at the background is white. That is the universal, or at least the truth in my house right now. And that is the factual thing. I think that phase emanates, or that phrase emanates from couple of data points, given the fact that the broader markets have done better than, say, just the Nifty kind of a thing. And if you look at the entire profit pool of those broader markets, and if, say, the mid cap index, for example, the total revenue, the profitability is X, the loss pool has been 50% of that, which means that it's not that all of them have actually contributed to that growth. Therefore, in the midst of, are we in a phase where there is going to be a growth-led movement in equity prices and therefore the buoyancy of the stock markets? I think it's a very, very fair statement to make. You can call it in whatever English, however Shakespearean you are, your English will better. But for a very layman, the answer is that if your country is growing even at a 10% kind of growth, which is very ambitious to have for other world economies right now, the expectation to at least have that much of returns on your equity portfolio is very fair. And now, yesterday I was in one of the panel discussions, and in one of the conversations, my equity colleagues said, made a statement that 15% agar mid cap mein agar aap expect karo over the next 2 to 3 years is not bad, because people are saying, oh, 150% return in 1 year. So are you going to get the same thing? I said it's fool's paradise to extrapolate. And I immediately came back on that, saying that, andhe mein kana raja hota hai, because at 15%, it is 3 times what the potential of what fixed income can deliver, given where rates are. So let's not be too ambitious. Yes, there has to be a moderation in expectation of returns, given that the underlying has performed exceptionally well. But yes, unless there is no third and fourth wave, which obviously either you need to be a medical practitioner or an astrologer to predict, and I am neither right now. I am just a market observer or a student of the market. I think these numbers are not impossible to achieve. So looks like the broad drivers in place to sustain a slightly more long-term equity rally is in place. It depends on where you're starting from.
Oh, absolutely. And in fact, as you rightly pointed out, right, 15% normalized return, I think that should be a fair estimate. But जैसे आपने कहा, I think you meet investors जो कहते हैं कि 4% मुझे दिन में मिलता है. So I think very difficult to convince the entire lot out there.
I would like to give my money to them, Mayuresh, honestly, because I don't make 4% a day.
Risk factor and credit risk, Lakshmi, extremely important.
अरे वहाँ risk लेकर भी नहीं मिलता है यार. 4% a day is like big money.
Sure. The last question before we end the day, Lakshmi. Shanmugan has a question that when bank FD rates at some point, as the rate cycle will go up again, as bank FD rates start going up, and obviously the bond or the corporate rates will come down because of the dent that you will see as a correlation within the offsetting that happens within asset classes. How do you then see, or how does an investor then exactly know the time or the trend on when to move between these asset classes if he has got exposure towards both, or should he not? He should stick with what he probably has.
On a lighter note, it is like someone always saying, I'm not yet ready for marriage. How do you know whether you're ready for marriage or not ready? It's not like a big dish that you put in the microwave and it is baked and ready. But that was on a lighter note, because these are very boring topics to discuss. But on a more serious note, there is a time lag usually between a monetary policy change, which means an accommodative to neutral to a tightening, or vice versa. Currently, we are in an accommodative phase. I think the first step towards, indicating that this easy money days are over would probably getting into the neutral gear. Ab neutral gear mein aap piche bhi ja sakte ho. You can go parking or you can zoom ahead also. At the current juncture, given where we are positioned and given where the globe is positioned, it looks reasonably likely that the time period between disembarking from here and embarking on a rate hike series is a good 3 to 4 quarters away. And historically, we have seen that monetary policy lags between the two policy movements is 2 to 3 quarters. So that will be the usual time period that you can track. And as I told you, markets are supreme. Markets can remain rational, I don't know, but irrational for longer than you and me can remain solvent. This is something which is very commonly noted and known. So I think markets have this uncanny ability to discount things way ahead of it. So at the current juncture, from a market mood perspective, bulk of it is in the prices. Yes, those 20-30% has to be a sleight of hand, as I call it. As far as bank fixed deposits are concerned, bankers even today are telling you and me my way or highway. यानी कि ये rate है, मेरा ये rate लो, नहीं चाहिए तो राम राम और mutual fund के पास चले जाओ, because portfolios in mutual fund reprice real time. But banks, as I said, because they are so flushed with liquidity, they don't want your and my money, and if they are taking it, they want it at their price, which is why I said my way or highway. So that will take slightly longer to reprice, but you get cues from the bond markets. Keep tracking the bond markets, and I say this to everyone, that this is the filmy in me talking, that the dhadkan in the equity markets is determined by the halchal in the bond markets. So please watch the bond markets, is very important.
Brilliantly put. So at the end of this, I can just summarize by saying all is well, all is well, all is well from Three Idiots, Lakshmi.
Mayurich, as long as you're not that Chaukidar in Three Idiots who was blind and said all is well and people actually believed all is well. As long as you're not that one, then it's absolutely all is well.
I'm Amir Khan. I'm always Amir Khan.
And I am Varun Dhawan. Chhajje se agar pani bhi chhoot raha hai, to I will say sab badhiya hai.
Brilliant. So thank you, Lakshmi. Thank you for your time. It was very, very insightful. Thank you for sparing time for us. And I'm pretty sure all the folks that who attended this had tons of takeaways to take from Lakshmi and her insights across asset classes. So thank you once again, Lakshmi.
Thank you so much. Take care.
And
Bye.
folks, you take care. Jab yourselves whenever you get the time if you have not done so far, and be safe as well. Thank you so much.
Okay, bye. See you.